Every single day, trillions of shares are traded on the world's major stock exchanges. And yet, statistics consistently show that a staggering 90% of individual investors fail to beat the market. Most people aren't actually investing. They are gambling on hot tips from coworkers or chasing the latest viral trend they saw on social media. But what if there was a way to strip away the noise and find the true weighing machine of wealth? In this masterclass, we're going deeper to show you exactly what to look for in a stock. But remember, I am not a financial advisor, and the content shared is not financial advice. You should always perform your own research before deciding on an investment. Okay, so we are breaking down the exact system used by the world's most successful investors, from Warren Buffett's 3 golden numbers to the hidden gems that the media refuses to talk about. We will explore why you should treat a stock like a hamburger stand, how to spot an economic moat, and the specific red flags that tell you to walk away from a deal. If you are ready to stop being a voter in the market and start being a professional weigher of businesses, pay close attention. This is your definitive guide to picking winning stocks. Before you open a single financial report, you must perform an internal audit because your personal goals determine your search criteria. If you are looking for a dividend stock to add to your portfolio for passive income, it makes no sense to look at small cap, high growth companies that are reinvesting every penny to expand. Conversely, if you want your capital to grow as fast as possible and you don't care about immediate income, you should avoid heavy dividend-paying stocks that distribute their profits to shareholders. When searching for dividends, a common sweet spot is a yield between 1.5% and 3%. This range often suggests that a company isn't paying out too much of its net income or free cash flow, which means the dividend is sustainable and likely to keep growing in the future. You also need to consider the size of the company. Do you want a small cap company with more risk but a much longer runway for growth? Or do you want the stability of a giant like Apple, a company with a proven track record of expansion and stability? Many seasoned investors suggest starting your search with companies that have a market capitalization of $5 billion or higher. Large businesses of this scale are generally more stable and possess significant track records that you can actually analyze. By focusing on major exchanges like the NYSE or the NASDAQ, you are filtering for the highest quality, US-listed stocks that are subject to rigorous reporting standards. Knowing your circle of competence and your specific goals is the first step to avoiding expensive mistakes in the market. With over 43,000 companies listed on exchanges worldwide, you cannot possibly research them all. This is where a professional-grade stock screener becomes your most valuable weapon. A high-quality screener allows you to analyze, score, and grade the fundamentals of thousands of stocks simultaneously, helping you find the most fundamentally sound candidates while avoiding the bad ones that are high risk. However, a powerful screener is as much about what you exclude as what you include. Many professional investors choose to deselect industries like energy, chemicals, and metals and mining. Why? Because these businesses are often unpredictable and heavily exposed to commodity price fluctuations. If the price of oil or copper drops, the company's profit drops, regardless of how well the management team is running the store. You want to find businesses that have more control over their own destiny. Look for companies that have been demolishing the S&P 500 historically. If a stock has grown massively since 2014, outperforming the general market index by hundreds or thousands of percentage points, it warrants a closer look. When you open their income statement, check their revenue growth. You are looking for consistency, businesses that have grown their top line basically every single quarter for the last 8 years. This type of historical dominance is often a precursor to future success, provided the company still has a runway for growth. There is a fundamental conflict of interest between you and the media you consume. The best investment ideas are rarely popular because popularity breeds high prices. Influencers and news outlets talk about companies like Nvidia or Tesla because those names generate the views and engagement that benefit the creator. They entertain you, but they don't necessarily make you money because the best stock picks are the ones that haven't become popular yet. Take the example of global pollution. Creators love to report on the plastic problem, how plastic particles are found in our food and are causing environmental damage. This generates outrage, which leads to clicks. But when a company like Aduro Clean Technologies presents a real solution to recycle that plastic and solve the problem, the media is nowhere to be found. Why? Because solutions are boring to the general public, whereas problems make people's blood boil. If you want to make serious money, you must go after things that are not popular yet. You must learn to look past the viral tickers and find companies solving major global issues before the rest of the world catches on. In the short term, the market acts like a voting machine, reflecting public opinion and popular sentiment. But in the long term, it acts like a weighing machine that measures actual earnings and profits. Active investors seek to exploit these short-term voting inefficiencies by buying undervalued companies before the weighing machine catches up. Warren Buffett says you don't need a team of analysts with fancy spreadsheets to find winners. You just need to understand three numbers. The first and most profound is return on equity, or ROE. This metric tells you how good a business is at making money with the capital that shareholders have already put in. To understand this, imagine you and a neighbor open a hamburger stand. You each put in $10,000 for a total of $20,000 in equity. At the end of the year, your stand makes $4,000 in profit. That is a 20% return on equity. This means for every dollar you've invested, you are getting 20 cents back in profit every single year. If a company can consistently earn a ROE above 15% or 20% for 10, 15, or even 20 years, it tells you something profound. The business has an economic moat. An economic moat is a competitive advantage that protects those high profits from being eaten away by competitors. This could be a brand people love, like Coca-Cola or Apple, or a network effect where the product becomes more valuable as more people use it. It could even be low-cost production that no one else can match. Buffett famously bought See's Candies in 1972 because its ROE was north of 30% year after year. That little candy company took the money Buffett left in the business and reliably turned it into more money, producing nearly $2 billion in earnings from a $25 million investment. The stock price tells you what people think, but ROE tells you what the business actually does. The second golden number is all about safety. Rule number 1 of investing is never lose money. Rule number 2 is never forget rule number 1. The debt-to-equity ratio tells you how much debt a company is carrying relative to its actual ownership value. Debt is a double-edged sword. In good times, it can amplify your returns because you are using borrowed money to make more money. But when times get tough, when sales drop, or the economy stumbles, debt can kill you. The bank doesn't care if your business is struggling. They want their money back regardless. Buffett has seen many good businesses destroyed by too much debt. Companies that could have weathered a storm but went bankrupt because they couldn't make their interest payments when cash flow slowed down. When looking at an operating company, you generally want to see a debt-to-equity ratio below 50%. Low debt gives you a margin of safety. Buffett learned this lesson the hard way with the original Berkshire Hathaway textile mill in the 1960s. It was a mediocre business struggling under debt, and he wasted years trying to save it. In contrast, a wonderful business with little or no debt is a fortress. Look at Apple. When Buffett started buying it in 2016, he loved that it had manageable debt and was sitting on a mountain of cash. That is the kind of balance sheet that lets you sleep well at night. If the debt-to-equity ratio is over 100%, be very careful and ask yourself, can this company handle a 30% drop in sales? If the answer is no, walk away. The final number is the price to earnings, or P/E ratio, which tells you what you are paying versus what you are getting. Price matters immensely. Even the most wonderful business in the world can be a bad investment if you overpay. The PE ratio is simple. It tells you how many dollars you are paying for every $1 of annual earnings the company generates. If a stock trades at $100 and earns $5 per share, it has a PE of 20. A low PE might look like a bargain, but you must ask why it is low. Is the business dying? Is it in a terrible industry? Sometimes a low PE is a value trap that deserves to be cheap. On the other hand, a high PE ratio, into the 30s, 40s, or 50s, means you are paying for a lot of future growth that may never happen. Buffett's sweet spot is typically a PE in the mid-teens to low 20s for a high-quality business. When you find a business with high ROE, low debt, and a PE under 20, all three numbers have checked out, and you have found a wonderful business at a fair price. This is exactly what he found with Coca-Cola in 1988. The ROE was over 30%, the debt was low, and the PE was around 15. It wasn't dirt cheap, but it was a fair price for an unbeatable brand. Once you find that combination, your favorite holding period should be forever. To verify these numbers, you must conduct your own due diligence. This is the process of researching how a company operates so you can decide if it belongs in your portfolio. Publicly traded companies are required by the SEC to report their financial information in quarterly reports called 10-Qs and annual reports known as 10-Ks. Despite the name, reading these is not a race. It's a marathon through hundreds of pages of detailed data. The heart of a business shows up in the income statement. Here, you can see the revenue, total sales, and what is left over after accounting for expenses like employee salaries and utility bills. This final amount is the net income, profit, or earnings. A common rule of thumb is that earnings and revenues should be growing both quarter over quarter and year over year. You should also look at the net profit margin, which is the percentage of revenue that remains as profit after all expenses. A company with high margins is usually good at managing its expenses and turning a profit. Comparing these ratios to a company's peers is vital because debt levels and profit margins vary from industry to industry. Don't just look at 1 year, look at trends over 5 or 10 years to see if the business is getting better or worse. Beyond the numbers, you must analyze the people running the show. This is known as management effectiveness analysis. While management can feel abstract, you can grade it using the return on equity ratio we discussed earlier. A higher number suggests the managers are masters at making money with your capital. Look for what Charlie Munger called the talented fanatic. A classic example is the early history of the National Cash Register Company, run by a CEO named Patterson. He was a fanatic who bought all the patents, built the best sales force, and created the best production plants. An idiot could see that he was so favorably located that he simply couldn't lose. You can find commentary from these leaders on investor relations websites or in the 10-Ks. Look for insights into product promotions, growth expectations, and potential dividends. Crucially, look for what could go wrong. Companies must disclose the risks they face, such as lawsuits or shifting market trends. If you understand the product and the nature of the competition, you are halfway to making a sound decision. As Buffett says, knowing what you don't know is just as important as knowing what you do. Investing is simple, but it isn't always easy. It requires the discipline to ignore the hot tips and the patience to wait for a fat pitch. In investing, unlike baseball, there are no called strikes. You can watch 100 pitches go by and only swing when a company with high ROE, low debt, and a reasonable PE comes right into your sweet spot. These three numbers won't make you rich overnight. They won't help you pick a stock that doubles in a month. Instead, they help you build wealth slowly and steadily over decades. Compound interest is the eighth wonder of the world. If you can earn 15% or 20% a year consistently, by owning great businesses, you will become incredibly wealthy. Before you buy your next stock, sit down at your kitchen table and ask yourself, is this a wonderful business? Is it safe? Is the price reasonable? If the answer to any of these is no, move on. There is always another opportunity. You don't need a Bloomberg terminal or to watch financial news all day. You just need to be disciplined. Thank you for watching. If you found this masterclass helpful, please leave a like and subscribe for more deep dives into the strategies of the world's best investors. What's one stock on your watch list right now? Let us know in the comments below, and we'll see you in the next video.